2015 and 2016 have been tough years for business, also characterized by both a rise in interest rates and non-performing loans. This was partly due to the rise in the CBR, as the central bank moved to put the election spending-inspired inflation under check. Today's move by the bank signals a step towards easing.
Given that inflation is forecast to fall back to the policy target of 5% over the next 12 months, Bank of Uganda believes that there is scope to continue easing monetary policy, and accordingly, Bank of Uganda will reduce the CBR by 1 percentage point to 15%.
With interest rates largely hovering above 23%, questions remain on how fast this move's impact will filter through.
You go for medical treatment. It is not, the touring is not immediate. So you start, but with the time. The maximum always takes in the range of up to 1 year. We always say monetary policy works with the lag. But we expect that the effect should be felt immediately upon announcement.
This will also depend on whether government keeps its stance on reducing domestic borrowing from the highs of over 1 trillion shillings to low of 612 billion shillings as promised in the 2016-2017 financial year budget.
So basically, in that case, therefore, the interest costs by the government should decline in 16-17. So if your government is borrowing only 612, and then you have a monetary policy easing, then automatically all the yields should come down, and therefore the domestic interest cost.
A rise in government borrowing at rates as high as 25% in 2015-2016 further pushed interest rates high, crowding out most of the private sector and compounding the woes of local players. According to the central bank governor, going forward, the economic activity in the country is expected to improve, mainly driven by domestic demand amidst continuous weakness in the external sector. Ingrid Nantege, NTV Business.